Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Discounted Cash Flow Analysis. Discounted cash flow analysis is a fundamental valuation technique used extensively in mergers and acquisitions. DCF analysis is predicated on the principle that the value of a company is the present value of its future cash flows. This valuation method is highly regarded for its robust theoretical foundation and practical applicability in determining the intrinsic value of a business, making it indispensable in the realm of M&A. The cornerstone of DCF analysis is the concept of the time value of money, which posits that a dollar today is worth more than a dollar in the future due to its earning potential. This principle necessitates the discounting of future cash flows back to their present value using a discount rate. The discount rate typically reflects the weighted average cost of capital, which is a composite of the cost of equity and the cost of debt, adjusted for the company's capital structure. To embark on a DCF analysis, it is essential to project the target company's free cash flows over a forecast period, usually spanning 5 to 10 years. Free cash flow is the cash generated by the company after accounting for capital expenditures necessary to maintain or expand its asset base. It represents the cash available to all investors, both debt and equity holders. The projection of FCFs demands a meticulous examination of the company's historical financial performance, industry trends, and macroeconomic factors. Analysts often rely on financial models that incorporate revenue growth rates, profit margins, capital expenditure requirements, and changes in working capital. Once the FCFs are projected, they must be discounted to their present value using the WACC. The WACC is calculated by multiplying the cost of each capital component by its proportional weight and summing the results. The cost of equity can be estimated using the capital asset pricing model, which considers the risk-free rate, the equity market risk premium, and the company's beta, a measure of its stock volatility relative to the market. The cost of debt is determined by the yield to maturity on the company's existing debt or the interest rate it would incur on new debt, adjusted for the tax shield provided by interest expense. The sum of the present values of the projected FCFs constitutes the enterprise value of the company. To derive the equity value, one must subtract the net debt from the EV. This equity value represents the intrinsic worth of the company's shares, providing a benchmark against which the market price can be compared. A pivotal aspect of DCF analysis is the terminal value, which accounts for the bulk of the company's valuation beyond the explicit forecast period. The terminal value can be estimated using either the perpetuity growth model or the exit multiple method. The perpetuity growth model assumes that the company will continue to generate FCFs at a stable growth rate indefinitely. This growth rate should be conservative, typically aligning with the long-term growth rate of the economy. The exit multiple method, on the other hand, applies a valuation multiple, such as EV/EBITDA, to the projected financial metric in the final forecast year. The choice between these methods hinges on the nature of the business and the analyst's judgment. To illustrate the application of DCF analysis in M&A, consider the acquisition of a mid-sized technology firm. Suppose the firm's projected FCFs for the next 5 years are $10 million, $12 million, $14 million, $16 million, and $18 million, respectively. The WACC is estimated at 10%. The terminal value, assuming a perpetuity growth rate of 3%, can be calculated as $18 million and $270 million. The present value of the terminal value, discounted back 5 years, is $270 million. 5 equals $167.7 million. The present value of the projected FCFs is $10 million plus $12 million / 2 plus $14 million / 3 plus $16 million / 4 plus $18 million, $8.26 million, plus $9.92 million plus $10.53 million plus $10.91 million plus $11.16 million equals $50.78 million. Therefore, The total enterprise value is 50.78 million, plus 167.7 million equals $218.48 million. If the firm has net debt of 30 million, the equity value is 218.48 million. 30 million equals 188.48 million. It is crucial to acknowledge the limitations and sensitivities inherent in DCF analysis. The accuracy of the valuation is heavily dependent on the quality of the input assumptions, such as the projected cash flows, discount rate, and terminal value growth rate. Small changes in these assumptions can lead to significant variations in the valuation outcome. Sensitivity analysis and scenario analysis are therefore integral to the DCF process, allowing analysts to assess the impact of different assumptions on the company's value and to identify key drivers of value. Moreover, DCF analysis is not always suitable for all types of companies. For instance, firms with unpredictable or volatile cash flows, such as startups or cyclical businesses, may pose challenges for accurate forecasting. In such cases, alternative valuation methods, such as comparable company analysis or precedent transaction analysis, may be more appropriate. Despite these challenges, DCF analysis remains a cornerstone of financial valuation in M&A, providing a rigorous framework for assessing the intrinsic value of a target company. Its emphasis on cash flows and the time value of money ensures that valuations are grounded in fundamental financial principles, offering a robust basis for strategic decision-making. In conclusion, the DCF analysis is a powerful and sophisticated tool for valuing companies in the context of mergers and acquisitions. Its methodological rigor and reliance on fundamental financial principles make it an essential technique for financial analysts and corporate strategists. By carefully projecting free cash flows, selecting an appropriate discount rate, and calculating the terminal value, analysts can derive a comprehensive valuation that informs M&A decisions. While acknowledging its limitations and the importance of sensitivity analysis, DCF analysis provides a critical lens through which the intrinsic value of a company can be discerned, guiding informed and strategic M&A activities. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.